From the morning reading, stocks rally after FOMC with no change. Spider bull flag bounce. Facebook gaps higher after hours. 6 of 9 sectors moved higher on Wednesday. XLE, XLU, and XLB were the strongest sectors, while XLK was the weakest sector for the second day in a row. Oil futures rose 67 cents to close at 45.33, its highest close since November of 2015. Breadth weakened as advancers led 2.32 to 1 on the New York Stock Exchange and 1.03 to 1 on the NASDAQ. The Fed announced interest rates remain unchanged today. Following the announcement, stock indices rallied. The spiders and the diamonds made a bull flag bounce entry, and IWM broke out of its horizontal bull flag again. The NASDAQ lagged the other broad indices and was led lower by Apple, Amazon, Microsoft, and others. Breadth continues to show odd readings. For the past 4 days, there have been extremes in the market's underlying number of advancing minus declining issues, despite small price changes in the S&P 500. This suggests that issues other than established operating companies are driving the market's moves, and the last time it happened so often over an extended period of time was prior to the tough market in 2015 and 2007 prior to that. Traders are scrambling to cover their short positions. In the most popular ETF in the world, SPY, shares that were sold short in order to profit from a decline have collapsed by more than 40%. This is supposed to be a bad sign, but since the fund's inception, big declines in short interest have preceded better gains than losses. Basic materials continue to power higher. The sector fund XLB moved to another new high for the rally off its January low. For the past 6 days, 100% of the components of the XLB have traded above their 50-day average. It has managed that 3 other times in its history, all leading to consolidation at least over the next 2 weeks. While it has been on a fantastic streak, those looking to get in now are more likely in for a period of frustration in the shorter term. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:27 a.m. Central Time, and I'm recording this in preparation for the market day of April the 28th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Let's go ahead and take a look at the morning report. And we've had some pretty significant action in the overnight, with all 4 broad market indices down pretty heavily. The S&P futures at the time of this cut were down over 13 points, or about 2/3%. Russell's down approaching 1%. NASDAQ down nearly 0.5%. Dow down about 0.75%. Crude oil is essentially scratch. Euro's up just above scratch. Bonds are up just a bit, just about 0.25%, and gold up about 0.5%. China's down about 1/4%. Hong Kong up just above scratch. Japan down big, down 3.6%. Germany down also pretty significantly, about 1.2%. And the United Kingdom down about 1%. In terms of macroeconomic reports for today in the United States, we'll note that advanced GDP, as well as the weekly variety of the unemployment claims, natural gas storage, pretty much rounds out today. Looking forward to tomorrow. Looks like we have core price and some personal spending, Chicago PMI, University of Michigan consumer sentiment, as well as a Treasury currency report without a time assigned to that. So a number of things coming up between today and tomorrow. In terms of current market conditions are volatilities, and I don't usually go into these upper factors here, but you should take note of these numbers. It gives you the 5-day average true range, and then also if you're a day trader it calculates a 30% target or 40% target. Many times traders will use a percent of the average true range for a few days as setting an appropriate size target. Other things here is to take a look at what is the tendency. Have we been increasing or decreasing? What are we looking at in terms of how high from the open to the high of the day? What's that average versus the open to the low of the day? What's that average? And you can get some tendencies out of this and be able to better define your targets and so forth. And our usual pattern, we usually in this market preview take a look at short-term VIX, see what it's doing. Relatively low here to 12.81 skew, and a similar number as yesterday, just above the threshold in which we call it a caution. IV percentiles continue to be extremely low. S&P at a 9, Russell at a 9, NASDAQ at a 14, and Dow at a 7. So implied volatilities across all four indices continue to just be remarkably low. And we've not really even gotten into the summer yet, though we're about to hit the fearsome May to Labor Day period. And I say fearsome in that it is often said to go away in May and basically come back, in September after the summer's over. What they're really referring to is the fact that it's often very, very kind of quiet and low volatility, low movement during those months, low volume many of those days. And that doesn't lend itself very often to very good follow-through for bull swings and stuff like that. So just kind of keep something in mind. It's actually not true if you study the seasonality pattern that you lose money during that period. It's more appropriate to simply say that you don't make a lot during that period, but it is actually slightly positive over history for that specific time period. So it's not advisable to just simply disengage and come back. That's actually would be a poor choice. But there is some adaptation to the trading that should be probably taken into consideration, and that is that your robustness in the typical summer is certainly going to diminish, and things will get to be lower volume. So other strategies might come more into play, such as perhaps even option income strategies and things like that. In terms of looking forward to the rest of this report, the standard deviation moves on a close-to-close basis yesterday. We had no standard deviation moves put in by any of the four broad market indices. Let's go ahead and go to our charts, and here's the S&P futures. And again, we like to use the futures chart. It gives us a better profile of what is happening, and that we capture all the professional activity, including overnight. And remember that more and more activity is happening in the overnight compared to especially 5 years ago or 10 years ago. The futures charts are generally going to give you the best pattern recognition, though we sometimes will look at the SPX and use that as well. So bottom line, though, you've noticed I've added a couple drawings here. I've been talking about this overhead area of resistance, so I put a rectangle on that to make that a little bit more obvious to you. And really this encompasses everything from the last May highs to all these kind of recent tops. We have a very clear channel top in place with many touches, including just a few days ago, of this area. And it starts out at about 2105-ish area and goes up to this 2134 high from last May. That is sitting like a ceiling above our current price action, and we definitely have been stopped by that for the moment. Now, obviously, all it takes is some energy, momentum, some sort of news event, or other impetus to power through eventually. And we will someday go through that. As to whether we're going to go through that now and we're going to power to new highs, or that we might revisit the area over and over again and continue to be stymied by that area, That is also a high probability, and frankly, probably the probability that you expect until proven otherwise. So you've had this really powerful move, some 13 percentage points off of the February lows, but now we've run into this really powerful overhead ceiling. So this is what all this consolidation is all about. Now, you notice also we have this rising intermediate term trend line and something of a channel here as well. And so we, right now, with the overnight action, you see we've pretty much invalidated much of the earlier activity of the week, and now we're kind of visiting the lows of the week. But there's still a little bit of room that we could drop to get down to the bottom of this channel and still be in an intermediate term bullish posture. So we're still just kind of watching this. But you can see it won't be that much longer, perhaps a week to 2 weeks, before this thing's going to have to kind of make a decision. Are we going to break down, or are we going to start to move up and through this area? At the very least, you'll run out of this channel and go into a sideways pattern. You know, they'll have to invalidate something here within the next couple weeks. So we're going to watch this pretty carefully. You're going to see that the other indices are looking very similar. The Dow here, of course, almost a mirror image of the NASDAQ, excuse me, I should say the S&P at this point. And then the NASDAQ, we'll go to that one next. NASDAQ has been looking different on the results of some really poor earnings on a number of major players, including Apple. You see Apple here had earnings, and look at this gap here. Though notice also, so it gaps down and almost instantly begins to start to fill this gap. So this gap down, not that far from a very important support area for Apple. So relatively good opportunity to take a defined risk position, to take this bullish from this kind of opportunity. You're risking perhaps, you know, $2-3 to make. If we get a gap fill, you could come all the way from, if you had gotten in at the open, $96, all the way back to 104 area. So there's probably more than a few institutions and traders who probably did jump on that kind of an opportunity, even though you might think, oh, it's bad news. That is a pot odds opportunity that many traders are going to go after. Also to note that these next few days will be important. We've now broken down. We're below the cloud. So, you know, does this just simply rally initially and then start to fall off? And if you look back here in the past, when they've had, let's see, here's a good example. Here's one. So you had a fall from earnings, and then, you know, initially a bit of a rally, but then it just kind of falls off. Now, eventually it does gather itself and then make this move. But bottom line to it is that, you know, these gap fills can require a little bit of patience sometimes. They often don't fill immediately, and they may chop around in a consolidation pattern before they start to gather themselves. So there's a little bit about Apple. And then let's take a look at the Russell. And you see the Russell, of course, is broken through the intermediate downtrend line and has been slowly but surely progressing its way up, including with yesterday and the day before's action breaking out of you know, some short-term horizontal resistance. And I think one of the morning authors may have even mentioned that yesterday. Let's see here. Volatility, not really telling us too much, pretty much in a consolidation pattern. And you see VIX here. We prefer to chart this on the volatility futures. And then also, let's take a look at bonds. Now, bonds have been ticking up, which should say that equities should be going down. So continue to watch that. And then GC, of course, correlations with gold with the rest of the indices can be very low, as a matter of fact, though sometimes when you have flight to safety, you'll see action go towards gold and bonds at the same time. Now, we would seem to have had a breakout with this last evening's activity. We'll see when the cash participants come in as to whether you see participation there. And remember, this overhead one, we kind of have a sloppy diagonal resistance area, lots of tails up here, and gold is subject to a lot of false breakouts. Gold is not the easiest market to trade. There's a lot of false patterns and probes with this market. So, small stops probably are pretty worthless in trading the gold market. Okay, let's go ahead and go to our daily report. And we continue to have, under slow but sure deterioration. And while we still have the intermediate term phase opinion phase 4, which is price patterns near horizontal resistance, on the S&P, which is our primary market that we follow, this is more about horizontal resistance than it is a breakdown of any kind of diagonal or horizontal support. But in other areas, we're starting to see, more warnings come up. In IBD, the first of our mechanical signals, has this as uptrend under pressure, so clearly a warning status there. Accumulation distribution, the NASDAQ dropped into warning status with a C+, though the S&P still retains a B. GMI index is at a 5 out of 6, and that buy signal still is in place, though there has been some internals. It's on a short-term sell signal with the NASDAQ at this point. Also notice that the GMI 2 is only at a 3 out of 8. That's also giving something of warning status. Our third mechanical signal, decision point scoreboard, we've had in recent days a number of deteriorating signals on the short term as well. Portfolio investor position sizing opinions at 50%. The volatility base position sizing is at a 75 to 100%. Intermediate term market posture for the 4 indices, another warning sign coming in here. The first of our 4 indices, the NASDAQ, which has had that very different pattern that we just talked about, dropping below an 80 and now weekly bearish. So that would say no new short-term or intermediate-term bullish trades on the NASDAQ at this point. So bottom line, though, the primary market we watch is the S&P. It's still very strongly bullish with a strongly supporting bullish sentiment line, though it is in itself in the upper reversal zone. So we're watching for an exit from there. Also note that this is now deteriorated down to an 83.8. If it drops below 80, much like the NASDAQ did with yesterday, it would also go weak bear. So many of these have started to deteriorate, and we're watching. And you may wonder, if you listen to us every day, much of the information is often the same from one day to another. But it is those subtle turns and the beginning of the tide changing, what we're watching for. And with this activity each day, that's how we notice these things, that the NASDAQ has turned, that the S&P is getting close to a signal, that these various accumulating signals, and much like these short-term signals coming in here, the GMI index giving us some deteriorating conditions, the deteriorating condition in the IBD signal, this NASDAQ accumulation distribution score, it's the sum of these continual deterioration conditions that give us our signals to make changes to the way we trade and invest and approach our management of our existing trades. So that's the value in listening to this each and every day. So back to our regular routine. Strength of the intermediate trend is currently a very strong bullish trend. We're up over 80, so no warnings there. Hedge warning status remains at a level 1, so the first level of elevated caution. In terms of specific opinions, option income strategies, cover calls, put selling, all are still at the same definitions that we had, the same opinions that we had yesterday. No changes there, but continue to apply your own personal level of risk assessment And it may be that you're starting to take some of these warnings and get a bit more conservative. So, for you, a 1-to-2 ratio of in the money, out of the money may no longer be appropriate. You may be going to 1-to-1 at this point. In terms of specific warnings, you have this volatility ratio warning. That's flagging. The NASDAQ and the S&P both have high distribution day counts. The skew has been warning us for the last several days. This was actually good yesterday. New York Stock Exchange. There's, plenty of black here that's also, telling us that things are bullish. And certainly all 5 of the key intermarket risk aversion indicators are still flagging as risk on. We tend to focus on where we see risk coming in, but in the absence of risk, it's bullish. So keep that in mind and keep perspective and balance. And the sentiment indicators, we've had a number of things showing up here to kind of indicate some increasing risk. Both the stocks and short-term and medium-term are at elevated sentiment levels. Fear and greed index is 72, so relatively high, though certainly not quite extreme. And the other thing we'll note is in our sector specific, note that consumer staples, technology, are the sectors that are, in the worst relative conditions for the short to intermediate term market postures. And the percent change yesterday was a pretty good day for most. Really, these are essentially scratch. Information technology was the one outlier, and certainly there was a number of tech earnings reports yesterday that were largely probably responsible for that performance. And I think that's enough for today. We'll go ahead and start our sequence here. We've gone a bit long, so I'm going to go and just roll through this. If you see something of interest, just hit the pause button, go to the hyperlink and get additional information. This is something I want to talk about in the next couple days. I've added a couple tips here. And disclaimers, as always, hit the pause button if you need more time to review the disclaimers. And as always, you note the full hyperlink at the bottom to take you to the full set of disclosures. We'll get back here tomorrow morning for the market preview from Falcon Global. And for all, good trading.